Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knakal Realty Services, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.
So here we are in the fall of 2010, close to 2011, and all of a sudden the investment sales market is looking very good. I mean, I'm the pessimist. People called me Dr. Doom and Gloom for years, and I'm still a little cautious, but I have today these 4 leading investment professionals to provide us insight on where they see the end of 2010 and 2011. My guests include Peter Hapsburg, the chairman and CEO of Eastern Consolidated, Jeffrey Baker, the executive managing director at Savills, David Noonan, a principal at Newmark Knight Frank Capital Group, and last but not least, I was going to call him, and I am going to call him the statistician, because he has these numbers down to a science, and I don't know, maybe it's a teleprompter. My good friend, the chairman of Massey Knakal Realty Services and Statistical Services, Bob Knakal. So, statistician, you were just saying before we started the show, 2.6%, 1.3%. What is this? Tell my audience in this illustrious group, what do you mean by this?
Well, Michael, generally in the investment sales market, we've seen a tremendous increase from last year, and that's not strange to see given how low levels were last year in all of 2009.
I mean, you couldn't go much worse.
Couldn't do much worse. There were only about $6.25 billion of investment sale transactions. Through the first 3 quarters of 2010, we've had $9.1 billion. So we're on pace to about double the activity.
Wait a second. If they sell 1118th Avenue before the end of the year for $2 billion, we're really on the pace.
Well, that's true, and that's why we also look at number of properties sold. In 2009, for the entire year in New York City, there were 1,436 properties sold. So far this year, there have been 1,237 properties sold through the first 3 quarters.
Now,
we're on pace to exceed last year by a good chunk.
My viewers are going to want to know if there's a teleprompter behind Hapsburg over here for your numbers.
Peter gave me all the information before the show.
Have we gotten up to the low levels of the early 90s yet this year?
We actually are running on pace to have a turnover volume in Manhattan anyway, and that's south of 96th Street, of about 1.7%. Last year, turnover was an all-time low in the 26 years we've been tracking it, where it was 1.17. Previously, the lows were in 1992 and 2003, which was 1.6. And we have to remember, those were both years at the end of recessionary periods, and they were also both years in which we saw peaks in cyclical unemployment.
So for the people who don't speak to statistics, Baker, what are you seeing happening today?
Well, we've seen the same sort of dramatic uptick in volume here. But again, when you're starting from almost zero, it's not that hard to beat the numbers. I will say, though, that I think our pipeline going into 2011 is probably 4 or 5 times what it was going into this past year.
Who's selling? I mean, David, who's buying and selling? What's the nature of the purchaser?
The nature of sellers back in 2010, late 2009, are people who had to. People who had a deal that got stuck post-Lehman, might have had a contract blow up. I've sold a lot of stuff for Verizon. They have a corporate agenda of simply eliminating excess real estate, and they're going to do that. They're not timing the markets. We've sold for some non-for-profits and other organizations who simply had pressure. They needed to sell. They were making a move. They were relocating. And in terms of buyers, we have looked to the user. The user was a kind of the best hope for good execution in 2010 and 2009. I think going forward, certainly there are a lot of investors who have been on the sidelines who've been waiting for things to break, and I see a more normal market going forward. But again, following up on Jeff's point, we did $50 billion in 2007, so to go from 6 to 9 is not so tremendous. And I think if you pull out some of those trades, depending on how you count, if you take out some of the equity recapitalizations, or if you pull out the macro trades, or you say, let's count SL Green out, it's really a pretty paltry level of transactions in the significant size range. So there's a lot of stuff trading. It's great for Bob in the smaller market, but in the large transactions, very little going on.
You know, Peter was saying prior to the show, and I think Bob was also agreeing, that land which you couldn't sell at all at the end of 2008 or the beginning of 2009 has been a big item today.
Yeah, land has probably almost tripled since the second quarter of 2009, which we sort of look back and call the bottom, and really couldn't get any offers north of $100 a buildable foot, and right now we're inking deals that are north of $300 and approaching $400, which are certainly almost
So here's
2007
the question on that. The banks are lending, but they're not really lending for construction. Construction is still,
I would disagree with that. There's a half a dozen condo projects going on in good locations in town where the lenders are in for roughly $600 a foot on a $1,200 break even, and
at that number I would agree with you. But I'm talking about, we're not seeing, there's no grasp of the amount of construction money that they used to be out in 2006, 2007. We don't have the Wrightwood capitalists, we don't have the Petras, we don't have the private investment funds running around to do construction loans.
No, Michael, clearly it's not 2006, 2007 again, but for the right project in the right location with the right sponsor, banks are competing to put construction dollars into the marketplace today.
But if you look at the health of the land market that Peter's seeing, bidding, people really competing to buy notes or fee positions, it's competitive and has jumped up. And then you look at the condo market, which is healthy, albeit at a reduced number. There's a big vacuum in between in terms of the health of the construction lending market, I think, and hopefully people will fill that vacuum. But in the meantime, that piece is missing, I think.
We're clearly seeing a resurgence in construction lending. I'm working on a large multifamily project up in Boston that'll certainly get done. There's projects in the multifamily sector around the country that are happening.
I don't want to be Manhattan-centric,
right?
But what's happening in the boroughs? Is land selling in Brooklyn?
Definitely lagging behind Manhattan.
I think one of the interesting things is that the land market most adversely impacted has been in the Bronx. And primarily, the Bronx actually had tremendous land sale activity in 2009 because of the affordable housing projects.
Land was selling for $75 to as high as $100 a foot because of the affordable housing. Right, because they were building, and then they could take the 421As and bring it to Manhattan.
Well, Michael, last year that number was down in the 30s, between $30 and $40 a buildable foot. But this year, the volume of sales in the land market in the Bronx is down by about 3/4 because the city does not have the affordable housing funds that they did. And so it's very difficult for affordable housing developers to deliver product to the marketplace today. So in the Bronx, we've seen a tremendous drop-off in the volume of land transactions.
What about Brooklyn, Williamsburg? That's still, sales are taking place.
You still have so many busted sites in Brooklyn that it's going to take a while to clean those up first before you get any resurgence in land values, I think.
And arguably, the supply backlog is much greater in the boroughs than it is
Absolutely.
in Manhattan. Manhattan, frankly, there's just not much of an inventory left.
I mean, I think, you know, of all asset classes, the multifamily is doing the best. I mean, from
Sure.
every I see, especially because the banks are out there. You know, the banks are out there, the GSEs are out there, and there is a lot of money out there. And, you know, there are new players out there. You know, Sovereign is still very aggressive. Investors and all these other players.
But if you look at the multifamily market, I think something that's very important to look at is the fact that yields on multifamily have continued to increase, and we're back to a point in time in which we have positive leverage in the multifamily business again. You know, if you look at the market over the last 25 years or so, you had a period of negative leverage throughout most of the 80s when the co-op conversions were going on. We had the S&L crisis, and then for nearly a decade, we had very conservative lending, conservative investing, and then we got back to the condo conversion craze, and we had negative leverage again, and we had our recent recession. A lot of people didn't think we'd get back to negative leverage, but right now you have cap rates for elevator buildings, for instance, in Manhattan are still less than 5%, but you can borrow in the mid to low 4s. And for walk-up buildings, cap rates are approaching 6% in Manhattan today. So the extent of positive leverage is fairly significant.
I mean, apartments are doing well. I mean, the office market, I mean, people were totally surprised. You know, I remember maybe I was at an event in June, and everybody said, you know, what is 685 Third going to trade for? You know, it's basically a vacant building. Who's going to go there? It needs a lot of work. And then TIA-CREF comes in and pays a high number. You know that building very well. You've been involved with that earlier generations. Where do you see office buildings, David?
That's still a number that is below what you would think the land itself would be worth on an FAR basis. It's 280, 290 square foot, so that looks cheap on a replacement cost basis. You obviously have a deep-pocketed player buying for it. You know, you still have 11 to 13% vacancy over 350 million square feet, and job growth, I think, was 12,000 this year, 12,000 office employees. That takes a long time to work through that kind of a vacancy. So it's a better market, it's a more stable market, it's a functioning market. Net effective rents are better. It feels like it's turning,
you know,
but it's certainly not a landlord's market.
There's someone in my office, he comes here from Israel. He's a friend of the company, and he had an opportunity last year to buy into the partnership who bought 4 New York Plaza at $98 a foot. And, you know, he told me that the same partnership, I think it's public information, is buying a building called 1412 Broadway now.
Right.
And, you know, and he says, you know, should I go into it? I said, look, it's a good building, but a lot of it relates to just what you just said. There's vacancy. It's not a great, you know, it's a B building. You need a lot of work. Right. He says, but look what they did at 4 New York Plaza. I said, 4 New York Plaza was 3 tenants. You had Chase, you had Daily News, and you had another. So you leased it up quickly. Now, I'm a little, and I know you've done work in Lower Manhattan. I think Lower Manhattan today, the AIG buildings, I don't see anything moving that quickly at 70 Pine.
No. The action downtown's been really slow. You agree?
Yeah, it's been below trend for sure.
And I think the play there was more of a residential conversion, frankly.
Yeah, but you see, downtown, when they got rid of the 421Gs, which I know the guys at Newmark were heavily involved with, you know, with the conversions and everything, that was a big difference. You know, you don't have that tax incentive to convert that building, so.
Yeah, I look at 510 Madison as a bit of a bellwether. If you look at that asset, before the markets collapsed, we had a forward sale deal with an offshore investor at about $1,600 a square foot. Their cost basis was $1,200. SL Green's basis when they bought the note was going to be about $750 a foot, and the ultimate price that Boston Properties paid was around $900 a foot vacant. So add another $100 for leasing, you're back up to $1,000 a foot. I think it shows tremendous confidence from the experienced REIT-type investors in the market.
You know, I think Bob may have said prior to the show, or Peter, you know, if you take out the SL Greens from what's happening. No, they were the biggest player this year. You know, the REITs, you know, if you look at SL Green, and now you take Boston Properties for 510 Madison.
And for the Hancock Building. In
And
Boston.
for the Hancock Building. You know, this is a different market. You
But
know,
Michael, that's not surprising, because if you think about what's happened in the CMBS market, I mean, when you're getting into 9-figure transactions and 10-figure transactions, you need access to public capital to make those transactions work. And that's why it's not surprising to see the REITs being so dominant, because they have access to public capital. I mean, what has CMBS issuance been this year? $10, $12 billion? I mean, it's a drop in the bucket compared to the $230 billion that it was in 2007.
now the big question on the collateralized CMBS, I'd like to do not inside baseball for the viewers, is that March 21st, 2011 is when the government has to come up with these new ideas if the investment bank has to hold back 5%, you know, so they can't be a bookmaker for 100% of the risk. If that happens, all bets are off on what the CMBS market's going to be like. But, you know, there are more banks, and, you know, we were talking on a show the prior week that, you know, the Chinese banks are here. You know, the Industrial Bank of China has been a major player. They've been going into buildings on Madison Avenue. You know, people never thought that they'd be able to refinance 650 Madison Avenue, but the world has changed. The rates are down over there. What about, and you
Again,
doing...
I'll interrupt though. You're seeing 1 or 2 transactions. You're not seeing a flow of transactions, and you're seeing Vornado bought a big retail piece recently. Toll Brothers, we talked about, they're public. SL Green is sitting on cash. Boston Properties, throw in Google might buy 111 8th. Carlos Slim, he's a guy who's got a pretty deep pocket. These are people with special capabilities that you're not seeing your run-of-the-mill buyer.
I'm not disagreeing. You know, if you look, I recently wrote an article about Israeli investors coming over here. You know, one of them, big eye shopping centers of Israel, is investing with Kimco today and diversified. So, you know, you're seeing different people. Gallagher Real Estate, the Ofa family, who's always been involved over here, is looking at the market. But I think, you know, the good deals everybody wants. I think, you know, that's the situation. You know, they don't know what the market is. Queens, what do you see in Queens?
Well, in Queens, we're seeing very, very low volume. And in fact, in all the boroughs, if you look at what's happened, I think it's interesting to look at how the third quarter performed, because I think it kind of put a little bit of cold water on the marketplace.
Yeah, threw us a little curve.
Yeah, we thought in Manhattan for 6 quarters in a row we had positive sales volume growth. In northern Manhattan it was 4 quarters in a row. In the second quarter of 2010, Brooklyn and Queens for the first time in many quarters turned positive in terms of volume. We thought that going into the third quarter, okay, the Bronx is going to be the next to be positive. We'll totally be on a very consistent upward course. And in the third quarter, every market, with the exception of the Bronx, lost steam relative to volume. Volume dropped in every marketplace. So, and that's both on a dollar volume basis and on a number of properties sold basis. So that was a little eye-opening. Now, we think that the fourth quarter will see volume increase again, as a lot of our clients are rushing to beat the anticipated capital gains tax increase. But you know, that's going to steal a little bit of activity from the first quarter of next year. So we're bouncing along, and this is very indicative of the way the general economy is
David brought up
moving.
a good point before when I brought up 685 Third, saying, you know, that if you look at the land cost, you know, you're buying the building basically for free, if you look at it that way. Do you see, you know, buildings were trading it for $200 a foot? You know, forget the situation. SL Green has been paying $650 a foot, $700 a foot, you know, for 600 Lexington Avenue and other properties. Do you see that trend continuing in the office market?
As long as interest rates stay this low and the office market doesn't deteriorate anymore, the answer is yes. There's not enough supply for the capital around. We had 2 trades in 2009 that dipped to $350 a foot. You know, you had Worldwide and you had 1540 Broadway, and then that was it. All of a sudden, it was back to $700.
Yeah, and I think, Michael, it's also important in the office sector to look at the exposure that buildings have to the market. And I think it's really a tale of 2 different markets. If you have buildings that are vacant or significantly vacant with a lot of lease roll coming in the short term that have market exposure, the price per square foot of those buildings is well below what they were at higher prices.
You remember when this gentleman was selling buildings that it was so great if they were vacant?
Absolutely.
I mean,
that trend has
this was
Nothing
what
but
you
upside.
wanted. I mean, hey, I don't want this building. I remember my friend Monsieur Denny buying the Brill building, saying, you know, this is going to be great because I'm going to have a vacant building over here.
In a market where rents are
rising
increasing, you want vacancy. In a market where rents are a little uncertain, you don't want vacancy. And so if you look at the average price per square foot of buildings that are well leased, that don't have market exposure, it's significantly higher than the buildings that have market exposure. So it's difficult to compare 200 a foot to 1,000 a foot without really looking at what the makeup and composition of those sales are.
I view it in the larger investment sale market office. It is a tale of two cities. Thank God we're New York and DC is the other city. And our client base is basically global. We see tremendous interest in investing here in Manhattan. And many of those groups we've been advising on deals that have gone to Boston Properties and the SL
Now,
Greens.
you know, there's something called the Garden State.
Right.
Do we see
Well-
investors going to New Jersey?
Yeah, absolutely.
I mean, forget the multifamily. I know they're going to New Jersey for multifamily because that's a market. Do you see the New Jersey investors for office buildings?
I think again, it's not a tale just of two cities, but also it's a tale of cities where a lot of the growth and the success of New York has drawn investment in from the suburbs. I think Connecticut. I think Connecticut. People like certainly Greenwich, Stamford, Westchester has always been difficult. New Jersey, in certain markets, certain great buildings, people are interested in. But I think people would rather get a B building in Washington than an A building in the suburbs.
But I think we're going to see it trickle down.
The
first wave is
the guys
the trophies.
in London, you can tell them
Yeah.
that there's something nice in Fort Lee, New Jersey, or Bergenfield. I think that's not the sexy.
Actually,
it's
Fort
much
Lee
more
is not a
local
bad.
players.
Right.
Fort Lee is not a bad example. There happens to be Asian interest in Fort Lee.
Asian interest in Fort Lee because there's a certain market, because of that market. But if you take other parts, and I think you hit it on the nose, in Westchester, buildings don't trade that well.
They don't,
I mean,
yeah.
they just don't trade.
And the overseas interest does not get on a plane and then get off in LaGuardia and then go to New Jersey. It's here. It's focused on Manhattan. Same the interest that's in London or in Paris. They're not looking.
Don't
at
you
secondary
think,
markets.
David, that you'll see the U.S. institutional investors that can no longer compete for the trophy in Manhattan, D.C. get pushed to these markets for the high quality property in New Jersey or Westchester?
I think you can compete better. You have a better chance of success in those markets. I mean, I'm talking to Peter probably as well. Veteran investors who were here in the '90s, who made fortunes, who are saying, I can't get something now. I can't find it. I got the war chest. I'm ready.
Yeah.
I've known you forever.
No problem.
My phone is ringing, and they're saying, "What do you have for me?" And there's very little. There's very little.
That's the biggest problem in the investment sales market today, is that we still have a very, very acute supply-demand imbalance. Many, many more people looking to buy than there are sellers willing to sell. And that's creating a situation where we're seeing a lot of our clients who are primarily New York investors that are going outside New York.
Are we seeing the private equity guys going back to buy? Have you seen? I mean, we know Angelo Gordon's back. We you know, there are a couple. But what about the other guys who've been hurt a little bit because they didn't do that well?
Well, think about how that capital has behaved over the past 5 to 7 years. I mean, it was institutional capital that really inflated that bubble in 05 to 07. And in the summer of 07, when we started to tangibly feel the effects of the credit crisis, that institutional capital all but evaporated.
Right.
Now, a couple of years later, we're seeing that they've formed distressed asset buying funds, opportunity funds.
Peter and
they're back
I
in the
know
market.
that some of these these funds who I was involved with and other people, really, banks don't want to lend to them because they say, we're a fund. We take no risk. We take no guarantee.
Michael, most of the transactions we're doing with the funds are not relying on bank debt. They're buying for 100% equity. Their strategy basically is to put some elbow grease into the asset and then finance it in a year or two after the property's been stabilized.
Distressed notes, selling, par. What's happening today? What do you see?
Starting in January, lenders and buyers seem to come together all of a sudden after 2 years of a gap between, buying and selling expectations. So we've done 20 or 30 note sales, and most of them have been either at par or not much less than 80% of par.
What about the default interest, legal fees, other situations you see?
Anecdotally from the courts, some people get it, and others, in other cases, you do not get it.
We've had a large number of note sale transactions in the last 6 months as well. I think the most notable was the W Union Square Hotel here in Manhattan, which traded at full par plus protective advances.
Now, are we seeing banks selling the fund, utilizing investment professionals, or are they still trying to do it, some of them themselves?
Every bank is different. It really depends on what their philosophy is. Some banks are willing to just make a deal or do a workout with the borrower. There are other banks that if the borrower was willing to pay 99 cents on the dollar, they're not going to make a deal with that borrower. So, and there's every philosophy in between. I think we've seen the banks certainly loosening up. The Fed's monetary policy has allowed for a recap of the banking system. They can absorb the losses.
What about the financing of the notes? Have you seen banks?
Some people do it. Citibank is selling some notes. They would rather probably sell it to someone they're close to and finance them.
Okay,
There's
that's
absolutely
a relationship situation,
Right.
I think, David. I'm talking about, there are banks. I know Signature is doing something right now. They'll do like 50% of a note. I think M&T might do some notes for certain people.
But Michael, some banks will finance up to 50%, but the overwhelming majority of note sale transactions are done on an all-equity basis.
Cash.
I would agree with that. There's financing available, but the terms are not that attractive generally if they're 30.
Especially if
being-
they're non-performing.
Yeah, and
It's
being able to close quickly is very, very important because the banks are so quarter-centric that a transaction closing on the last day of the quarter is much more valuable to them than a deal
that's true.
closing the next day.
David?
And they don't want the problems back. It takes a lot of institutional aggravation to get the commitment sometimes even to make a deal on these notes. So they don't want to finance. They don't want to see them again.
So in summation, it's better, but it's not really great. I think that's the
Well, the
comment.
800-pound gorilla in the room is that $1.4 trillion of CMBS notes that are now coming due, not counting the CDOs, not counting the banks the FDIC has taken. What's going to happen when this product drops?
So since we're out of time, we're going to have you back in 2011 to continue this discussion. But I'd like to thank Peter Hapsburg, Jeff Baker, David Noonan, and Robert Knakal for being here. See you next week.
Thank you.
Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knakal Realty Services, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.